you've got the flexibility all the way through. You can choose the currency, you can choose the term, and you can actually define what the utilization is in relation to the underlying trade loan or trade loans that the borrower would be making to its customers. Multi-flexibility, that's the idea.
Welcome to the most exciting slot of the day. My name's Deepesh Patel. This is our first ever live podcast recording as well. So there will be a podcast recording. So Geoff, please don't swear. Today we're diving into the 2025 Master Trade Loan Agreement. Not another acronym, MTLA, but a very important agreement. And we're going to be talking about the implications for our industry.
Welcome to Trade Treasury Payments, the podcast unlocking the future of cross-border finance.
From transaction banking and money movements
to liquidity, treasury, and cash management.
We bring you expert insights and the latest trends shaping global finance.
Now, the BAFT MTLA has long been a key document for banks financing trade transactions, and this latest version is a major overhaul. And as we've covered throughout the day, trade finance continues to rapidly evolve. There's lots of shifting regulations, changing market structures, digital transformation, and the MTLA has been a key document for banks financing trade transactions for over a decade. But in 2025, obviously trade looks a lot different to what it was in 2014. To start off with, I'm going to do a quick survey around the room, and I think that's going to lead our discussion, Geoff, if you don't mind us kind of veering off piste a bit. Before we begin, can I just ask from the audience, first of all, can you put your hands up if you've heard of the MTLA, the Master Trade Loan Agreement? So hands up in the room if you've heard of the Master Trade Loan Agreement. So I think there's about 2/3 of the room have heard of it. Keep your hands up if you've used or are using the 2014 version of the MTLA. So have you used or are using the 2014 version of the MTLA? No one has their hands up. So I was going to say, one person has their hands up, so that's going to, I guess, feed into our discussion. Geoff Wynne, partner at Sullivan. You don't need an introduction. I think everyone knows you very well. But let's start by talking about this transformation, and actually let's start with a bit of history. How did we get here, Geoff? What are the key drivers that led BAFT and Sullivan to kind of develop the overhaul of the agreement?
As you rightly say, a lot has changed since 2014. So it was not very difficult. If you looked at the MTLA of 2014 to see that it needed some changing. And I suppose the classic that got everybody saying we've got to do something is that there was a thing called LIBOR, which was quite a convenient way of calculating interest, which many of us had lived with for many a year. That had its demise. As a result of that, something needed to change in the document. Other regulatory matters had come in. We had Brexit, we had bail-in wording for banks, we had data protection wording. So it looked like something needed to be done. But actually, I'm interested in the number of hands that were raised who knew about the MTLA, because one of the questions was, well, what was the MTLA? It was a Master Trade Loan Agreement, but for whom, to whom? And that was one of the questions. So when we started talking with BAFT about what could be changed, BAFT set up a working group of a lot of very good people involved in the industry. And one of the first questions that we asked was, well, what should this document be used for? Was it a document that would be used for trade loans, in other words, loans by a bank to a corporate, or was it actually a document that was to be used between banks? And the agreement was that actually what it was always intended to be, although not that clear, was a document whereby one bank, a large bank in many cases, acted as lender to a smaller bank to enable that smaller bank to use the proceeds of that loan to finance trade loans that it was making to its corporates. When you were armed with that and you looked at the wording, it became clear that actually an overhaul would be rather useful to make that much clearer. That was our starting point.
Thank you very much. And you gave me some good weekend reading, actually. I did have a glance through the document. And the 2025 MTLA introduces a modular structure. It moves away from that monolithic approach of 2014. So instead of one fixed contract, we now have trade loan requests and acceptances forming smaller transaction-specific agreements. Geoff, can you elaborate on the reasons behind this shift and how that benefits both the lenders and the borrowers?
So if you looked at a template form, you would start asking questions like, what currency, what country, where would we make a start, what interest rate? As a consequence of that, if you started creating a master that would be used just to evidence a drawing, you would have a huge number of optional parts that you had to work out. So a business day means a day that is open for business in A, B, C, and if a payment is required in Z, and so on. So as we started discussing with the working group, we reached the conclusion that you could streamline the master document very much along the lines of the BAFT Master Risk Participation Agreements. So it set out the key terms that would apply between the lender bank and the borrower. But then for each specific utilization, you could then tailor it by using, as we described it, a trade loan request, which came from the borrower and which was accepted by the lender. And therefore, any of the discussions that would go on about where would I borrow, what currency, what interest rate, would then be taken out from the master, which would sit there having been signed and negotiated going forward, and would then be reflected in the individual trade loan request. So hopefully a much more flexible approach.
Thank you very much. And also another new feature. Gosh, this sounds like a sales pitch. We do want all your hands up at the end saying we are going to consider using this, by the way. The new offer and acceptance mechanism for trade loans is quite a significant change. Can you perhaps walk through how that process works and its advantages?
Right, so you sit there with the master. So you've agreed your basic terms. You've agreed representations and warranties, undertakings, events of default. You can then focus on a specific utilization of funds. And you can actually make it even more flexible because banks have different branches, different offices, so that you could actually make available a particular utilization on the trade loan request to a borrower in a particular jurisdiction. Remember, the borrower is also a bank and therefore may have branches. The lender may have different branches. So you've got the flexibility all the way through. You can choose the currency, you can choose the term, and you can actually define what the utilization is in relation to the underlying trade loan or trade loans that the borrower would be making to its customers. Multi-flexibility, that's the idea.
Thank you very much. And I guess the other interesting feature is the booking office. Mm-hmm. I think it allows parties to select relevant branches, as you mentioned, for specific trade loans. I guess, what implications does it have for risk management and regulatory compliance?
Well, it gives the flexibility. If you want to make particular advances out of particular jurisdictions, or indeed, if you have a facility, remember, this facility does not have to be a single currency. So it's not a dollar facility. It's a facility that it's uncommitted, but could be available in any different number of currencies. So if, for example, you were a UK bank, but actually wanted to make your euros available out of Paris branch, you could do that, and so on. So that was the idea, was the flexibility. But we didn't create, as the BAFT document does, the idea of a different legal entity. So the booking office has to be the same legal entity. We didn't think it was a good idea to go any further than that. So you can't have affiliates, for example. Got to be the same legal entity of both the lender and the borrower.
Thank you. And we talked about the phase out of LIBOR. How does the 2025 MTLA accommodate new reference rates like SOFR and SONIA. And what should banks be mindful of during this transition?
The answer is it does and it doesn't cover it. Because it's not currency specific, it means that what we left in place is the fallback that we've seen, which is the central bank rate. But the reality is that the lender and borrower can agree term SOFR, term SONIA, whatever they want, depending on the currency and depending on the specific transaction they want to finance. And there are plenty of places where you can find wording that you want without having to put a huge amount of optionality into this master. Because if you said, well, it might be, I might want to lend yen at one point, I might want to lend Swiss franc. And so the master would then have had huge numbers of pages. Now it doesn't. And you just choose what you want when you come to the specific utilization.
Thank you. So a lot more flexible with regards to those reference rates. The other interesting part of the document is that there's an optional sustainability clause, and it's a topic that we've discussed throughout today. Given the global push towards, well, or even against ESG considerations, how do you anticipate banks adopting some of those provisions, if they want to?
Well, you actually just answered your own question, because they may or they may not. So what we did was, BAFT did a lot of work on their sustainability provisions, but some banks may not want them, some borrowers may not want them, may not be able to use them. So the idea then was, again, instead of overloading the document with sustainability wording that might not be used, it sits in an annex. And the way it gets brought into play is that the trade loan request the borrower makes, if it wants to make a request for a sustainability loan, it can do so and will automatically then bring into play the annex, which the lender can accept or not. So again, you've got, if you like, basic trade loans, or you've got sustainability loans, and there the twain shall meet.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
I'm going to take a risk here and now take a read from the rest of the room. For those 2/3 of people that put their hands up saying they are aware of the MTLA, would you be able to put your hands up if you think you would consider using the 2025 MTLA based on this, or at least if you think you'd consider reading the document and seeing whether your bank would consider using it? We've got the gentleman who, I think you put your hand up earlier, didn't you, about the 2014 MTLA, so it's good to know that you're going to upgrade. But there are a couple of people here, so we have progress, which is good.
I haven't read it. It was put on the BAFT members website, I think, at 2:00 this afternoon.
Well, they were busy watching the conference.
They were all busy doing all sorts of other things. But you can go back to your rooms or over the drink, you can have a look at it. Look, it's good that there's an immediate positive reaction, because if you think about it, trade finance is getting money from big banks to smaller banks, and from smaller banks to the people who really need the money, their SMEs or whatever. This is a facilitator for it. That was the idea.
Right. So I guess, Geoff, in light of some of the recent geopolitical events, and you've seen massive shifts in US trade policy and regionalization trends, I think they call it RCI, regional cooperation, integration. How does the MTLA position banks to navigate some of these challenges, would you say?
Well, I'd love to say that we are so forward-looking that this will stand the test of years. But of course, it's a strange geopolitical world. But I think because it's a flexible way of going forward, if, particularly as a major bank lender, you can sign up with your borrower that's also a bank and get the framework in place, you've got the flexibility for each trade loan request to meet whatever is coming to hit us. But at least you've done a lot of the negotiating now that takes you forward. That was the idea.
Mm-hmm. And I guess with the rise of many digital platforms and various technologies, I won't go into all of the details, but would you say MTLA could align with some of those advancements?
Yeah, because if you like, we are media neutral to it. So listening to SWIFT discussions, yes, we can do these as SWIFT loans, as many are being done. We can do this electronically. We can develop into the digitalization of trade. So yeah, there's nothing that stops that happening. I mean, conceptually, I suppose I had envisaged that the MTLA itself would be, I would say, signed, would exist in paper, but the trade loan request and its acceptance can be whatever medium anyone wants to use, any digital medium.
How are you going to measure success of the use of MTLA?
People instruct me to know. How would I measure the success? I hope that the BAFT membership will see it as an additional weapon in how they document trade loans. Mm-hmm. I think we would say that would be successful if there is a take-up.
Thank you very much. I mean, will it put you out of a job?
No. The idea of creating templates and the idea of making life easier, anything that reduces that huge trade finance gap has got to be good for everybody. Because remember, this is documenting a lender to bank borrower. The bank borrower onwards, there's plenty that needs to be done there in order to make sure that the lender bank's money is secure and going into the right sort of trade loan.
So a practical question for that lender to bank borrower. What practical advice would you suggest giving them? You know, many of the people that put their hands up earlier who are considering whether to adopt it, what are the practical next steps?
The first step, look at the master document and see if you think it fits in with how you would like to evidence the relationship with a number of your particularly emerging market bank borrowers. Although I think there's quite a large take-up of the MTLA in the US anyway. This is not emerging markets, but because I happen to like trade finance in emerging markets, I think this is good. It's a relatively simple document. I mean, without sort of knocking loan market association documents, this is not 200 pages long. Pick a mix. This is 30 pages. It's bite-sized, it's understandable, it sets up a relationship, and then you've got the flexibility with your trade loan request to go forward and do lots of trade loans.
Noting the correspondent banking session earlier, how do you envisage this closing the gap, particularly in those emerging and developing markets? How can banks utilize this to their advantage for that purpose?
Well, you've got to persuade, if you like, the larger banks to set up relationships with smaller banks. This is designed to make it easier to do that. And then it's also then designed, because it is not prescriptive as to what the borrower bank does, how it evidences its on-lending or its relationship. It is multi-flexible. The battle will be to persuade people to do it. But that's been the problem of narrowing the trade gap for years.
And I guess looking ahead to, let's say, the next 5 years, not 10 years, we barely know what's going to happen next month. But do you foresee how this document might evolve, any further refinements to provide even more flexibility for the way the industry is changing?
Well, I hope not. I hope that we've been flexible enough to set up the relationship between lender and borrower, but in the knowledge that anything specific can be met in the trade loan request, which can have extra conditions put there. But the idea, anything that encourages the expansion of trade finance has got to be good news. So that's what I'd like to see going forward.
Thank you very much. I would like to open the floor if anyone has any thoughts or even comments or questions about the MTLA, be that the 2014 version, if they've had any challenges with it, or perhaps they explored using it in their bank, or about the 2025 one that's been released. So if anyone has any questions, please do feel free to put your hand up, please. The question for ladies, is it enforceable in every borrower's jurisdiction? Yeah, globally.
Well, the answer is one would hope so, but it's an English law governed document. We're actually delivering a legal opinion that says it's enforceable. But as a lender bank, you would have to do your due diligence. But the advantage of, if you like, the master structure is you do it once, so that you've got the benefit of the representation in day one. So you will only do that with a borrower bank that can borrow under an English law document. The lending arrangement being created by a trade loan request that's accepted. So there are no tripwires in the document designed to make it difficult. It's designed to make it easy, to facilitate arrangements between lender and borrower banks.
Did that answer your question? Thank you. Arlene has the microphone, so please direct any questions towards the microphone. I have one concluding.
There's a horrible one on Slido.
There we go. So why only trade loans, and why has BAFT not considered to roll out similar documents for guarantees and LC facilities? We might even have to defer this to Tom.
I'm not BAFT. But in some ways, why would you need it? If you want guarantees in a format, you've got URDG, Uniform Rules for Demand Guarantees, you've got letters of credit, you've got UCP. It's always difficult to persuade banks to standardize beyond their own standard forms. So this was just a good starting point. I imagine if the BAFT membership think that a standard arrangement whereby a bank would issue guarantees on behalf of another bank, we can do it. And the same with letters of credit. In fact, I have lots of discussions on letters of credit between issuing bank, confirming bank, and so on. But this is lending. This is the bread and butter, if you like. And getting this moving, particularly in emerging markets, for trade loans to SMEs, that would be great news. If we came back in a year's time and said, this is really rolling, that would be great.
What are the questions, the challenges and hurdles that perhaps some of those lenders might come to yourself or to BAFT with regards to adopting that standardized MTLA wording?
The idea is that it's a good standard. Remember, it's an uncommitted, unsecured facility. So bank and borrower bank need to know each other and be happy to document that relationship and then to look at what the underlying use of funds will be. But I'm not expecting lots of changes. It's a strong working group. We think we've got the balance right. Yes, of course, it's biased towards the lender, but it's not an over-onerous document. As I say, I'm just hoping that it gets used and people get very enthused by it and that we see a growth in trade loans from borrower banks in their own marketplace.
And potentially reduction in legal fees as well.
Why is it always, was it the first thing you do is shoot all the lawyers? There'll be an increase in work because there'll be so much done. People want to document it.
I am joking. The BAFT MTLA is now available, Arlene is nodding, on the BAFT website, and it's free for BAFT members or an inexpensive purchase for non-BAFT members. We'll continue reporting on it, and I think Craig Weeks is the BAFT contact. Did you have any questions? And of course, the BAFT guys here. But Geoff, thank you very much.
Pleasure.
Thank you.
Get using it, everyone. Thank you.
And don't forget to follow Trade Treasury Payments
on your favorite podcast platform.
Thanks for listening.